Welcome, everybody. We'll just give everyone a minute or two to arrive, and then we'll begin. Hello, everyone, and welcome to our webinar today about understanding the Main Street Lending Program funding forward. Please post your questions in the Q&A section only. A recording of this webinar and slides will be posted shortly on our community site at realtimeandinc.com, and later in the day, we will email a copy to participants. Briefly about myself, I am the founder and CEO of Multifunding. I am an Inc. columnist writing regularly on business lending issues. I've featured regularly in the press and advised the White House, Federal Reserve, and Treasury markets on business credit markets. I have a book out called The Growth Dilemma, and I'm an EO board member of Philadelphia. Some disclaimers my lawyers asked me to read. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. Multifunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for us to be reimagining our businesses and thinking about what is next. This is the time to be preparing for battle as we rebuild and reemerge our businesses. This involves a strategy where we pivot 5%, 50%, or 90%. This involves sorting out what our team looks like, and this involves getting our ammunition ready for this battle, and in this case, ammunition is cash. And we are looking for ammunition for both offensive and defensive needs. How much cash will be required to get your business back on a stable footing? What is the best case and worst case scenario? And where will the cash come from, and how much are you willing to personally risk? And what does your future look like, and what opportunities will you want to consider? This is what I want to discuss the Main Street Lending Program with you today. It has $600 billion allocated, and it is in effect until September 30th, 2020. It is comprised of 3 facilities: the new, the priority, and the expanded. I want to be clear that this is not an entitlement program like the PPP. Banks can accept or decline these applications at their discretions. And if it is the case of a particularly risky application and you do not have a current relationship with the bank, they have little incentive to take your loan. If you plan to use a Main Street loan to expand and grow, more banks will be open to you. But if your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank. You will get these at banks. I've heard some consultants out there and investment banks offering services where they have non-bank people claim they have non-banks participating in Main Street loans. This is at this point not legal. To be eligible, your business must be established prior to March 13th, 2020. If you have more than 15,000 employees or $5 billion of revenue, you are too big, and your business has to be created or organized in the United States. What is the U.S. eligibility test? An eligible borrower has significant operations in the United States if, when consolidated with its subsidiaries, greater than 50% of your borrower's assets are the United States, annual net income is generated in the United States, annual net operating revenues are generated in the United States, and annual consolidated operating expenses are generated in the United States. Subsidiaries of foreign companies can apply as long as they attest that the money will not go to their companies abroad. To be eligible, you need to be a partnership, an LLC, a corporation, an association, a trust, a cooperative, a joint venture with no more than 49% participation by foreign business entities or a tribal business concern. There's currently a program underway for nonprofits, but it is not open and functional as of yet. Ineligible borrowers include developers, landlords, and specific other speculative industries. Affiliation rules apply. An affiliated group of companies can only participate in one Main Street facility. The affiliated group's loan cannot exceed the maximum loan amount for that facility. An eligible borrower's maximum loan size would be limited by its own leverage level, the leverage level of the affiliated group on a consolidated basis, and the size of any loan extended to other affiliates in the group. There are three facilities: the new, priority, and the expanded. Let's dig into the new and the priority first. They share some attributes. They are secured or unsecured term loans with a 5-year maturity. Principal payment is deferred for 2 years and interest payments are deferred for 1 year. The unpaid interest will be capitalized. You pay at the end of year 3, you pay 15%. At the end of year 4, you pay 15%. And at the end of it, there's a 70% balloon payment. These rates are based on the adjustable rate of LIBOR plus 3%. So right now you can assume the rates will be approximately 3.25%. Prepayment is permitted without penalty, and fees to originate the loans are between 1% and 2%, although almost all lenders we're aware of are charging the full 2%. The new facility loans are between $250,000 and $35 million. How do you calculate what you are eligible for? Well, let us take an example in row 3 of a company with 2019 EBITDA of $500,000. The maximum loan they could get would be $2 million or 4 times that. And if that company had existing debt of $1.5 million, you would subtract that to give a potential new money loan of $500,000. If that same company in row 1 had existing debt of $500,000, their potential new money facility would be $1.5 million. What's important here is if you have existing lenders, what their rights look like. In case of bankruptcy, the new lender must have the same rights as other lenders, except for your mortgage lender. But in the normal course of business, the new lender's rights can be subordinate. So if you have existing lenders, you have to negotiate with them, if you get a Main Street new facility, that they will share rights with that new lender in case of bankruptcy. These loans can be secured or unsecured, depending what you negotiate with your lender. While the program does not state that their personal guarantees are required, that is at the lender's discretion, and most of all the lenders we are talking to are demanding personal guarantees. The borrower can take new secured or unsecured debt after receiving one of these loans, providing that the new debt would not have higher contractual priority in bankruptcy than the Main Street loan. The priority facilities share many attributes, but these loans are higher. They go from $250 to $50 million. And they work at 6 times 2019 EBITDA, not 4 times. So to take an example of row 3, that same company with $500,000 of EBITDA, if they were trying to get a priority facility, they could potentially get a $3 million loan. Their existing debt, if it was $1.5 million, their potential new money would be $1.5 million. If that same company had $500,000 of existing debt, as in row 1, their potential new money loan would be $2.5 million. Eligible borrowers may, at the time of origination of the loan, refinance the existing debt from other lenders into a priority loan facility. This is a new feature that is not part of any of the other programs. But in the priority facility, the lenders' rights have to be senior or on par in all cases with other lenders. And these loans can be secured or unsecured, depending upon what you'll work out with your lender. As a very baseline, a company with $41.66 thousand of 2019 EBITDA and 0 debt could borrow $250,000 under the program. Expanded facility is the third facility, and these loans run from $10 million to $300 million. How do they work? Let's say in row 1, a company with $10 million of 2019 EBITDA, the maximum priority facility, expanded facility they could get would be $60 million. If that company had $25 million worth of existing debt, their potential new money loan would be $35 million. These rights tag along with your existing lender, and an expanded facility has to be issued by your existing lender, so your existing lender has to participate in the program. They share many of the same attributes, but the fees to get in are lower, between 0.75 and 1.5%. In all of these loans, you commit to not using the money to repay other debt, and you can commit not to cancel or reduce your other lines of credit with your lender or any other lender. And you certify that you have no reason to believe that your business will go bankrupt in the next 90 days. While you have the loan, you can repay a line of credit, including your credit card, as part of your ordinary course of business. You can take on additional debt as long as they don't interfere with the rights of your Main Street lender, and you can refinance maturing debt. But you do commit to certain compensation, stock repurchase, and capital distribution restrictions. There are exemptions for this for S corporations or other tax pass-through entities. You agree while you have the loan and for up to 12 months after the loan is paid in full, not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you agree not to make more than that while you have the loan and for 1 year thereafter. For those who earned above 3 million, so you earned 6 million, you take the difference between 3 and 6, 1.5, you add that to the 3, and your compensation is capped at 4.5 million. You agreed to make reasonable efforts to retain your employees while you have the loan, but unlike PPP, this is not the primary focus of this program. Your lender will, if you're working with a lender you've worked with historically, they will be required to calculate your EBITDA or consider any adjustments to your EBITDA in the same way they have historically done that. If it is a new lender, they will have to choose a comparable example of a company like yours and take that example of how they calculate your EBITDA. Your debt will be calculated on the day of your application and will include all existing outstanding and undrawn available debt from private and bank lenders. If you have an asset-based line secured by accounts receivable and inventory, the amount that will be included is the amount that you have borrowed against it, specifically what is available, not what you could borrow. How do you pick between the new, the priority, or the expanded? Let's take an example on road number 2 of a company with 2019 EBITDA of $4 million and existing debt of $10 million. They could get a new facility of 6, a priority facility of 14, or an expanded facility of 14. And they would have to pick what made most sense for them depending on what their banks would allow and what their capital requirements were. Financing strategy is very much like offense and defense, and I want to share with you 3 examples of how borrowers we are working with are taking advantage of the program. One example is a company with a $3 million line of credit and $1 million drawn. This line of credit has a personal guarantee. They are planning on getting an MSLP for liquidity, and they would rather not personal guarantee the capital required to reestablish the business. Again, just to reiterate, while this is their desire, almost all lenders are demanding personal guarantees on these loans, and this could create a tricky situation for this particular borrower. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And the third example is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies of the dollar and use the MSLP money to help. How much money will be required to get your business back on a stable footing? What is the best case and the worst case scenario? Where will the cash come from and how much are you willing to personally risk? And what does your future look like and what opportunities will you consider? These are the things I think you need to think about as you think about if the Main Street is a priority for you. And with that, further ado, I'm going to invite the moderator to take your questions. Please post them in the Q&A only. Thank you.
Thank you, Ami. Is there any limitations on what you can use the borrowed funds for?
The question is, are there limitation on what you can use the borrowed funds for? And the answer is no, as long as you do not use them to prepay old debt.
Do you know if anyone has received funding from this program yet?
We know we have many clients who are in the process of getting funding at different stages, but have not received the money yet.
What about an LLC owner and manager on receiving monies?
And they would be have the capital restrictions, the distribution restrictions as we outlined in the presentation. That's a pretty quick set of questions, folks. Does anyone else have any questions, thoughts, suggestions? Feel free to share.
Have any of the clients that you've helped with the loan done so without a personal guarantee?
Not as of yet. We're trying to negotiate it with banks, but haven't been successful yet.
How do we start the process of applying for our loan and have not found any local banks?
I don't want to sell. We are helping clients through the process. You can reach out and discuss it with us if you like, or if you just keep, looking for local banks in your area who might be participating. Happy to take any other questions.
Are you going to address the P4 in the future?
I'm sorry, I don't know what you mean by P4. If you want to clarify, I'd be happy to discuss. Any other questions? Going once, going twice. Come on, folks, give me some questions. Okay, well, if we have nothing else, so Jeremy has a situation of EBITDA of $700,000 and vehicle debt of $500,000. Jeremy, you should absolutely be eligible for a Main Street lending program, depending on which program you use. For either, you should, in theory, be able to get $3.7 million of new money if you have a good use for it. Any other questions, thoughts, asks, suggestions? Going once, going twice. We're going to wrap up, folks. Thank you so much for your time, and happy to help in any way we can. Take care now. Bye-bye.
Thank you, Ami.
Thank you.